Welcome back, everyone. I'm actually going to be continuing with my myth busting this episode, so we'll be revisiting the top 10 myths, part 2, so myths 6 to 10. Let's get stuck in. The first myth, number 6, is I don't need to enrol in my workplace pension. First of all, why wouldn't you? Essentially, if you enrol in your workplace pension, you'll be getting free money from your employer and from the government, but only if you enrol yourself. When you start a new job, you'll get asked if you want to enrol in your workplace pension, or really you'll be asked if you want to opt out of it. You should get automatically enrolled generally after 3 months of working at that new employer, but you do have the option to opt out if you don't want to be enrolled in it. If you opt out, your employer doesn't owe you any money. They don't owe you any pension contributions whatsoever, so you're missing out on that money from your employer, that extra money. You won't be getting that back in any other form, you just won't be getting it. Whereas if you do automatically enrol into a workplace pension, you will pay into it and your employer will pay into it, and then the government will be topping up your contributions by some form of tax relief. So really, in my eyes, it's a bit of a no-brainer. It's definitely worth doing. If you have opted out previously, please do ask your employer if you can opt back in at some point. They should be able to arrange that for you. Now, automatic enrolment, there are certain qualifications that you have to meet to be able to automatically enrol. You have to be a certain age and be earning a certain amount. So it's worth talking to your employer if you haven't been automatically enrolled and just asking them why that's the case. And it might be that you just fall slightly out of that catchment, but do ask the question and enrol if you can. Myth number 7, carrying on the automatic enrolment theme, is my workplace pension will be sufficient. Now, that may well be the case, but have you really looked at it and really thought about if that money is going to be enough to get you through your retirement? Your retirement could be 20, 30, 40, maybe even 50 years long once you stop working. And do you know how much money you really need to have put away to be able to fund that sort of longevity if you're not actually working and you have no other income streams? Your state pension will come into payment at some point, generally in your late 60s or maybe even your early 70s by the time you get to that age. And what other money do you have put aside to help you through your retirement? You probably have accumulated several different workplace pensions along the way. It's not unusual, certainly for millennials, to have had 10 or 11 jobs throughout their working life. So first of all, you need to make sure that you're keeping track of all your pensions and then look at what that money is, where it's invested and how much it is. Then at least you can keep track of what you're accumulating along the way. Now, unless you're going to crunch the numbers yourself, the only way you're really going to know if that's enough for you is to go and see an advisor, someone that can help map out your retirement journey and tell you how much you need to put away. But to do that, you need to work out how much you think you're going to need per year in retirement, and that's something that a lot of people don't really think about. Most people's mortgages are paid off by then, so your outgoing really do reduce, but it's probably something to sit down and really have a think about, because the sooner you do it, the sooner you can start saving extra money if you need to make sure that you have the retirement that you want. Myth number 8, I can't afford life insurance. Many people do say this, they don't look at life insurance because they really think it's unaffordable to them, but there is a life insurance product for every type of budget. There are cheaper policies and more expensive policies, and that's so that there's an element of choice, so that you can at least have some sort of life insurance that meets your budget. The cheapest types of life insurance are generally mortgage cover, so decreasing term insurance, which goes down year after year if you're on a repayment basis mortgage. They can be as low as, say, £6 to £10 a month, and that means that if one of you dies, then the mortgage will get paid off, and then the remaining survivor doesn't have to worry about paying the mortgage. There are other forms of policies as well that can be cheap, or there are cheaper versions of them. Income protection, for example, there are ways you can make the premiums cheaper, but still give yourself some element of cover, so it's definitely worth looking at. Please don't rule out any form of protection policies because you think it's going to be too expensive. That really is not true. And if you do want to look at those options, then please do let me know and I can talk you through what options are available to you and what will meet your budget requirements. Financial myth number 9, I don't need an emergency fund. Now, you may well have seen my other videos about emergency funding and how important it is, especially one about saving versus investing and about savings in general. But I think this year, 2020, has really highlighted how important an emergency fund is. If you've been furloughed or made redundant and your income has dropped significantly, then how are you going to get by? Or how have you been getting by, really? Even if you have protection policies in place, they generally won't start to pay out until a certain time frame has passed, 3 or 6 months, for example. So you need to make sure you can get through that time before your income protection, for example, kicks in. If you don't have money sitting around, you will probably have to go and ask friends and family for help. You'll have to be taking things like mortgage holidays, which are available at the moment, or they were available earlier in the year. but lots of things like that aren't necessarily going to be around for a long period of time. So an emergency fund is really important, so that you have money set aside in a cash account that you can cover yourself for, say, 3 to 6 months worth of your expenditure, and it's really important to build that up as soon as possible. If you don't have any emergency fund at all, just start by putting a little sum aside every month into a cash account, and over time that will build up. Don't worry that you have to be throwing hundreds of pounds in at a time. It doesn't work like that. If you can do that, that's fine, but just drip feed as much as you can into a savings account over the next 12 months or so and just see where that gets you. And then just do that on a regular basis, and before you know it, you'll have a good sum of emergency savings set aside. It's definitely worth doing. Last but not least, myth number 10. Only pensioners or wealthy people need a financial advisor. Of course, pensioners and wealthy people do need financial advisors. They can help in certain ways, but they're not the only people that should be seeing advisors. For example, when you want to buy a house, or if you start having a family and you want to look at ways to protect that family financially, then that's really where financial advisors can help you out. They can map out your life, your financial life, and your financial plan, and you can just see what sums you need at what points in life. You can build in things like planning to buy a home or planning to help children or grandchildren out along the way. But the younger you are when you see a financial advisor, the more they can help you out and the more they can keep you on track to meet those targets. Financial advisors certainly can help in the accumulation stage of wealth as well. Things like setting up pensions or accumulating workplace pensions, if you've got several of those that have accumulated in the past, or if you want help setting up savings or investment plans, they can certainly help with those things as well. So it's really advisable to go and speak to a financial advisor as early as possible. If you also keep them on an ongoing basis, it means they'll always be at the end of the phone, and then you'll have a long ongoing relationship with that financial advisor who can help you out financially throughout your entire life. Okay guys, that's all the myth busting done then for this year. I hope you've enjoyed it. If there's any more myths you want me to bust, let me know in the comments below. But otherwise, like the video, subscribe to the channel, and I'll see you next time.